Making decisions about what to do with your money can be complicated. With so much advice, how do you know what is best for you?
Local financial professional Cory Chapman from EFC Wealth Management is here to debunk some money myths. So we welcome you.
Thank you so much. Appreciate it, guys.
All right, let's just get right to myth number one. So in terms of investment, a lot of people think, I don't have enough money. I don't make enough money to invest.
Well, you know, it's interesting, you know, it's the little things start to add up over time. So I think the very first thing that most people can do is really start with a little bit. Start putting money away, no matter how small you think it may be, and over time it starts to add up, and you'll be surprised how it turns out.
Where do you put, so where would you save that money if it's just, you know, people who are living paycheck to paycheck and they want to save, let's say they can save $50 per paycheck, or where would you recommend that they put that into?
There are a lot of great apps out right now that you can take advantage of and literally start doing systematic monthly deposits right into that account. So it could be as little as starting to build up in a basic savings account, finding who has the most interest rates that are out there, let it build up over time so you can then use that money to apply towards a larger type of investment at the point.
That's a good idea, because if it's automatic and you don't see it, then you don't know.
You don't miss it.
Don't even think about it. Exactly.
Yeah. All right, myth number two, investing in the stock market is just too risky.
You know, I know it's scary right now with the stock market being up and down, and every time you look like you have all these scary thoughts that are going on. But I tell you, it's all about finding that goal that you're trying to set up for yourself. You know, really it comes down to that long-term financial goal that takes in consideration of your risk and your tolerances towards risk, and more importantly, whatever your long-term goals are. So I'd say that at the end of the day, it's really about starting, figuring out what a long-term plan is for you and what's going to work best for you in the long term.
And people don't realize that out there when you're investing in the stock market. It's not necessarily you're just investing in one stock and it goes up and down, but you're often putting these stocks in mutual funds and things that really kind of like, you know, make sure that the risk is spread out.
Yeah, and I mean, that's really what it comes down to. You know, most people are trying to time the market and look for the best stock that's out there, but it's really about your objective, what you're trying to focus on. You know, at the end of the day, you're trying to figure out what's going to be the lifestyle that you deserve in retirement, so how do I invest for the long term?
Okay. Myth number three, a credit card should be used for emergencies.
You know, I kind of disagree with that in some sense, and here's why. I think at the end of the day, you can use your credit card, but use it wisely, right? Make sure at the end of the day you're focused on not only what you're spending it on, but often paying it off by the end of every month. That's really what it comes down to. Where most people get into trouble is when they put something on the credit card that came up and it carried over time, and now those interests kind of grew too much, and now it makes it difficult to pay it off. So just be diligent about paying it off at the end of every month.
Which reverts back to number one, which is save. So if you're saving some money, perhaps if you did that $50 a month and save for an emergency fund, have that emergency fund.
You know, most people should have about 3 to 6 months worth of reserves set aside so they can fall back just in case an emergency comes up and they don't have to put it on the credit card.
Myth number four, I'm too young to save for retirement.
Totally a debunk, right? So at this point in time, you know, saving sooner than later is always better. You know, here's the great thing is that the sooner you start saving, we have that beautiful thing called compounding interest rate. If you do it sooner, it starts to build up over time and it makes a significant difference. So the sooner you can, the better.
Okay.
Have you done that with your own kids? I mean, have you sort of instituted that into your save it, because the compounding interest really is where this comes
it's
into
magical.
play.
I mean, think of it from like this. If you had a $10,000 investment and you started investing at age 20 and it sat there until age of retirement at a 5% interest rate, it's about $73,000 it grows to just by waiting 10 years at age 30 doing the exact same 10,000 investments, right?
Yeah.
At that point in time, it doesn't even get to at least $43,000. So it's even less. So the sooner the better always works out.
Let it ride.
Let it ride.
Let it ride. And myth number five, I'll be in a lower tax bracket when I retire.
You know, guys, I got to tell you, this is probably the biggest one we got to change up, because here's the thing. Most people, when they go into retirement, their focus is about living the same lifestyle they live now or better. So if you kind of think about it, if most of your income that comes into your household is coming from your 401k plan or your IRA accounts, it could possibly push you into a higher tax bracket. So you don't necessarily go in a lower bracket just because you're retiring. If you've done your job right and if your financial advisors helped you build up, you could be in a higher bracket. So you definitely want to come up with a plan that kind of make sure you're understanding what tax liabilities may come up.
And your final word about the stock market, I mean, you alluded to it going up and down. Today we had a good jobs report, so then we saw it rise at opening bell, and it was, last week that it dropped tremendously, or the week before. So what's your takeaway?
You know, I think at the end of the day, we got to not worry so much about all the noise that's going on out there. We got to really focus on what our overall goals are, because lifestyle plays a big role. And if you do it right and have a good financial advisor to work with to kind of help you through that process, you'll get to the goals you're looking for.
A lot of us have a champagne, what's the champagne
Champagne
taste on a beer budget? Yes.
Yeah, I'll get the cheap champagne.
Yeah.
Smart and final.
Smart and final.
Cory, thank you.
I appreciate it, guys. Thank you.
Thanks, Cory.